Okay, recording has started.
All right. Good evening to Madam Tai. We are Group 1 from Section BO1, and today we will be presenting our financial analysis on Petronas Chemical Group Berhad. Now let's start with part 1 of our company background.
Good evening, Madam and everyone. Today, I will present a financial analysis of Petronas Chemical Group Berhad, one of the largest integrated chemical producer in Southeast Asia and a subsidiary of Petroleum National Berhad. The main objective of this analysis is to evaluate the company financial health, operational efficiency, and investment potential over the last 3 years from 2020 to 2024. 2022 to 2024, sorry. We aim to see how well Petronas Chemical manage its asset, liability, and overall financial stability in a competitive global chemical industry. We select Petronas Chemical because it is not only a leading company in Southeast Asia, but also has a strong global presence. Its parent company, Petronas, is world-renowned in oil and gas, power generation, and even industry like Formula One racing with over 30 years of experience. Petronas Chemical provide detailed annual report and industry data, which make a reliable financial analysis possible. Petronas Chemical was established in 1985 and operates 21 manufacturing sites in countries including Malaysia, Netherlands, Germany, China, India, USA, and Canada. Its main products include polymers, fertilizer, methanol, and specialty chemical. The company has a vision to be the preferred chemical company providing innovative customer solutions and has received multiple awards for excellence in chemical engineering and sustainability. Recently, the company faced challenge reporting a net loss of 1.08 billion in Q2 2025 due to weaker product spread and foreign exchange loss. However, it still maintains a strong financial position and is planning strategic initiatives such as cost optimization and operational improvement. To assess Petronas Chemical performance, we use three main financial analysis techniques. First is horizontal analysis. Horizontal analysis is compare financial results across years to identify trends in revenue, expenses, and profit. The second one is vertical analysis. It shows each financial item as a percentage of a base figure like sales, helping to understand cost structure and profit margin. The last one is ratio analysis. It evaluates liquidity, activity, debt, profitability, and market performance using specific ratio like current ratio, return on equity, and price earning ratio. By combining this technique, we can see the company's strength, efficiency, and area for improvement, giving a clear picture of its financial performance and market position. Thank you.
Hi, my name is Yufu. I want to talk about the ratio about the Petronas Chemical Group Berhad, and this is the statement, the 2024 and 2023. This is the income statement, and this is the 2023 SOFP, and this is the 2023 and 2022 the SOFP also. This is the income statement, and this is the statement about the ratio that we need to find at the day 517 7 ringgit 16, 8 ringgit 53. Yeah, and I'll talk about the liquidity ratio. Current ratio is the ratio that measures if a company has enough current asset to pay its current debt. It calculated by dividing current asset by the current liability. Quick ratio is show whether company can meet its short-term liability without relying the inventory. The formula is the cash plus account receivable divide current liability, and also can be account current asset minus the inventory divide the current liability. Cash ratio is the measure company ability to pay short-term liability using only cash and cash equivalent. Is found by divide cash by current liability. Activity ratio, inventory turnover. This ratio show how quickly inventory is sold during a period. This is cost of sold divide the inventory. Days used in inventory is 300, is show how many days a company take to sell its inventory. A lower number suggests faster and more efficiency inventory turnover. The calculation is 365 days divide the inventory turnover. Receivable turnover is the ratio indicator how efficiently a firm collect its account receivable. The formula is sales divide account receivable. Payable turnover is measure how often a company pay to supply during a period. It is calculated by dividing the cost of goods sold by account payable. And the days used in receivable is show the number a day the company can take how collect payment from each customer. The formula is 365 days divide receivable turnover. And the day cost in payable is show average number to the day to pay it to the pay supplier. And the formula is 365 days divide the payable turnover. And the total asset is measure how effectively a company use its asset to generate sales. And the formula is sales divide total asset. Capital intensity ratio is indicate how much capital is needed to generate $1 of revenue. The formula is 1 divided the total asset turnover. Just now we find. And debt ratio is the total debt ratio is the measure the proportion of a company asset that are financed by debt, and the formula is the liability divide the total asset. The debt equity ratio is compare a company total debt is shareholder equity. The formula is the total debt divide the total equity. And the equity multiplier show how much a company asset are financed by shareholder equity. And the formula is the 1 plus the debt equity ratio. Profitability ratio. And now we talk about the profit margin. Profit margin show the percentage of revenue that remain as profit after all expenses. The return on assets show how effectively a company use its asset to generate profit. And the formula is net income divide the total asset. Return on equity is measure how the return generated on shareholder equity. And the formula is net income divide the total equity. The market ratio now is compare company share price to its earning per share. And the formula is the price per share divide the earning per share. Price sales ratio show how much investors are willing to pay per dollar of a company sales. The formula is price per share divide sales per share. And the last, market to book ratio, it measures the common shareholder equity of a corporation against the market cap. The formula is the price per share divide the book value per share. Okay, thank you. Next.
Hi, my name is Pufeng Kai, and I'll be doing the ratio explanation. For the first one, it is the liquidity ratio analysis. The liquidity ratio analysis measures how much the company is capable to meet the short-term liabilities of their own company. The discussion shows that there is a troubling situation of deteriorating liquidity for Petronas. The current ratio has decreased significantly from 2.46 in 2022 to 1.68 in 2024. This downward trend indicates that the company's buffer for covering its short-term liabilities with current assets has been eroding. This can be seen with the increasing amount of current liabilities from year 2022 to year 2024. While a ratio above 1 is generally considered healthy, the notable decline points to increasing pressure on its short-term financial position. Next is the quick ratio. The quick ratio has shown a steady improvement over the 3-year period, increasing from 1.31 in year 2022 and 1.47 in year 2024 and 2023, and reaching 1.92 in year 2024. This upward trend suggests that the company has become increasingly capable of covering its short-term liabilities using its liquid assets and without needing to sell out most of its inventory. Third is the cash ratio. The cash ratio dropped from 1.37 in year 2022 to 0.89 in year 2024. This is a critical indicator that signifies the company's cash and cash equivalents alone are no longer sufficient enough to immediately cover its short-term debts. This trend highlights a tightening cash flow position and increased short-term funding risk. The overall assessment is that the liquidity ratio of Petronas Chemicals Group per heart is on a decreasing trend. Although it is not directly in a crisis, the decreasing ratio shows that there is a point at which the company will experience a rise in financial burden. Next is the activity ratio analysis. The activity ratio analysis will determine the effectiveness and efficiency with which Petronas Chemicals Group Berhad is using its assets to achieve sales. The outcome of the analysis reveals a general decrease of the efficiency of activity of Petronas. The inventory turnover ratio has reduced to 5.85 as compared to 6.35 in year 2022, demonstrating that the company is slower in selling its inventory. Days to sell inventory indicates that there are more days to sell inventory in year 2022 of 57.43 days as compared to year 2024 of 62.23 days. This means that the company is taking an increasing amount of time to sell its inventory annually. Third is accounts receivable turnover rate. The turnover rate has dropped from 8% in year 2022 to 6.25 in year 2024. This suggests that the company is taking longer to collect payments from its customer, which is a bad sign, and it negatively affects the cash flow and working capital cycle of Petronas. Days sales in receivable shows an increase from 45.63 days in year 2022 to 55.98 days in year 2024. The increase in days to collect payment from customer corresponds with the calculation in the account receivable turnover ratio. Accounts payable turnover ratio has fallen from 3.42 in year 2022 to 2.58 in year 2024. This shows that the company is delaying payments to its suppliers and is taking this can temporarily improve cash on hand. It can worsen the relationships with suppliers, which may cause issues in the future. Days cost in payables shows an increase from 106.72 days in year 2022 to 141.47 days in year 2024. Lastly, the total assets turnover ratio has seen a substantial decline from 0.85 in year 2022 to 0.5 in year 2024. This means that the company is generating less revenue for every dollar of assets it holds, which is a red flag. For the overall assessment, the efficiency of the operations and activities of Petronas Chemicals Group Berhad is on a downward trend. This is reflected in the slow increase in inventory sales, account receivable collections, and payments to customers and suppliers. This is an indicator of difficult market inefficiencies in the internal operations of the company, which makes growth difficult. Third is the debt ratio analysis. Debt ratio analysis measures the company's ability to meet its long-term financial obligations. The debt ratio aspect appears to be the most stable aspect of the company's financial profile. while total debt ratio has increased from 0.46 to 0.31, which is a positive sign. It indicates that the proportion of the company's assets financed by debt has decreased, strengthening its overall financial structure. The debt to equity ratio has increased from 0.27 to 0.5. While this shows a sign rising reliance on debt relative to equity, the ratio remains at a manageable level. Lastly is the equity multiplier. The equity multiplier has risen from 1.27 to 1.5, which is consistent with the increase in the debt to equity ratio. However, it still indicates that shareholders' equity remains the primary source of financing. The overall assessment is that the company maintains a solid and stable financial structure. Its debt levels are low and manageable, indicating that it is not a significant risk of defaulting on its long-term obligations. The strong capital structure provides a crucial buffer against the operational challenges it is facing. The fourth is the profitability ratio analysis. It is one of the most important indicators that a company, as it indicates how much a company makes in earnings and profits. The result of that, however, the result of the analysis indicate that there's a worrying negative decrease in the sphere. For profit margin, it has collapsed from 21.85% in year 2022 to a mere 4.2% in year 2024. This drastic drop is the most critical issue highlighted in the analysis, indicating that the company does not have the ability to convert its assets to generate earnings. The return on assets has fallen sharply from 11.14% in year 2022 to 2.1% in year 2024. This reflects a significant decrease in the company's ability to generate profit from its total assets. Lastly, on return on equity, it has dropped substantially from 15.9% in year 2022 to 6.4% in year 2024. For the overall assessment, Petronas Chemicals Group Berhad is experiencing a serious decline in its profitability. This has been evident in a remarkable decline in profit margin between year 2022 and year 2024, and decline in the return on assets and return on equity. The last one is the market ratio. The market ratios analysis draw an insight into the perception of the market and investors on the value of the company. The statistics are an indication of a change in the market feeling. Price to earnings ratio has jumped from 10.88% in year 2022 to 35.17% in year 2024. This high price to earning ratio could signal high growth expectations. However, given the dramatic drop in profitability, this is likely a result of the denominator earnings shrinking significantly, making the stock appear overvalued relative to its current earning power. Price to sales ratio has increased from 1.35 in year 2022 to 2.38 in year 2024. This shows that investors are willing to pay more for each dollar of the company sales, potentially speculating on a future turnaround. However, this is not supported by the company's current profitability, adding to the risk. Last is the market to book ratio. Market to book ratio has declined from 2.58 in year 2022 to 1.034 in year 2024, nearing 1%. This is a powerful indicator that the market perception of the company's future value has significantly deteriorated. Scroll down. Scroll down. For overall assessment, the market ratio signal on the Petronas Chemicals Group Berhad supplemented that is by its high price per earning ratio may indicate that the market is losing trust in the company to enhance company growth. For the conclusion and strength and weaknesses, for the strength, the company has a strong and stable financial position, low level of debt, and has a high level of equity. This reduces the chances of insolvency in the long term and buffer to get through the present challenges. However, there are many weaknesses. The most significant issue is the erosion of profitability. The dramatic drop in profit margin, return on assets, return on equity is a major red flag that undermines investors' confidence and the company's long-term viability. The operational efficiency is also declining, evidenced by the slow inventory and accounts receivable turnover, and the liquidity is also a growing concern, as the company's ability to cover short-term debts with liquid assets is decreasing, highlighting a potential cash flow squeeze. The overall outlook, the company has a strong financial base because of its low debt ratio. Nevertheless, it has suffered great deals in terms of its operations and profitability. These problems are becoming more noticeable, and the most important task in the future will be to find solutions to the core reasons and solve the problems regarding decline in profitability and they need to enhance the efficiency of the operations. The financial and market performance of the company will be under pressure without a strategic change towards enhancing the core business performance if there are no changes made in the future. Next.
All right, my name is Ruby and I will be presenting number 5, which is discussion of financial strength and weakness. So Petronas Chemical has several important strengths. The first one is its integrated operation and diversified product portfolio help spread risk across multiple lines and allow capture of more value along the chain. Scroll down. And then secondly, the company has a strong balance sheet with continuity of dividend and liquidity position. Now we will discuss about the weaknesses of Petronas Chem. There are some notable weaknesses of Petronas Chem. The first one is the company has exposure to forex losses, especially from US denominated loans, which heavily impacted 2024 earnings. It also faces margin pressure due to high operational costs, weak downstream demand and softer pricing. Apart from that, its earning growth and dividend has also been downgraded, reflecting cautious sentiment. Together, this shows that Petronas Chemical is financially solid, its profitability is volatile and exposed to external risk. As for the financial implication, we can say that there is constraint in cash flow, reduction in earning capacity and losing investors' trust. Now I will move on to part 6, which is investment analysis and recommendation. Now looking at the financial trend and the industry outlook, Petronas Chemicals investment attractiveness is moderate with elevated risk. The company has strong revenue growth and scale advantages, but its sharp earning decline is a concern, especially compared to peers like Lotte Chemical Titan, who maintain steadier performances. This means that PChem is stable but profit pressured. As for the slide, our recommendation of investment is to hold. Scroll down. To hold. For existing investors is to maintain position but avoid increasing exposure until there is more evidence of recovery. The trigger to buy would include margin recovery, stronger EPS growth and steady dividend cover, whereas the trigger to sell would be to further EPS erosion, dividend cut or liquidity stress. In short, PChem has long-term potential, but turning revenue strength into consistent profit will be key for future growth. Now I will be covering the conclusion. Scroll down. To conclude, our analysis highlight that PChem is a financially stable company with strong market positioning but faces pressure on margin and earning. The importance of financial analysis here is clear. It allows us to look beyond revenue growth and assess how sustainable profit, dividend and overall financial health truly are. Therefore, our recommendation is to hold with a close watch on profitability, trend and cost efficiency improvement. Thank you, and this concludes our presentation.